Hello, our course topic for this lesson is Exchange Traded Product ETP, the definition, types, and benefits. An Exchange Traded Product ETP is a type of investment vehicle that is traded on a stock exchange, similar to individual stocks. ETPs are designed to provide investors with exposure to a wide range of asset classes, including stocks, bonds, commodities, and alternative investments. These products are structured to track the performance of an underlying asset, index, or strategy, offering investors a flexible and cost-effective way to diversify their portfolios. Let's move around the key features of ETPs. First, traded on exchanges. ETPs can be bought and sold throughout the trading day on stock exchanges, allowing for real-time pricing and liquidity. Underlying asset. Each ETP tracks the performance of a specific underlying asset, index, or strategy. Transparency. ETPs often disclose their holdings daily, providing investors with a clear understanding of what they own. Low expense ratios. Compared to actively managed funds, ETPs usually have lower management fees, making them cost-effective. Then, flexibility. Investors can use ETPs for various strategies, including hedging, income generation, or sector-specific exposure. Okay, types of exchange-traded products. Now relax and listen up. ETPs come in several forms, each with distinct characteristics and investment objectives. We have the exchange-traded funds, ETFs. ETFs are the most common type of ETP and are designed to track the performance of a specific index, sector, commodity, or asset class. Exchange-traded notes, ETNs. ETNs are unsecured debt instruments issued by financial institutions. They track the performance of an index or asset, but do not hold the underlying assets. Exchange-traded commodities, ETCs. ETCs provide exposure to commodities like gold, silver, oil, or agricultural products. They are either backed by physical assets or use derivatives to track commodity prices. Leveraged and inverse ETPs. These ETPs aim to deliver multiples of the performance, leveraged, or the inverse of the performance of an underlying index or asset. Of course, exchange-traded products has its own advantages. Liquidity. ETPs can be traded throughout the trading day, offering high liquidity and real-time pricing. Diversification. Many ETPs provide exposure to a broad range of assets, sectors, or regions, reducing portfolio risk. Cost-effectiveness. With lower expense ratios compared to actively managed funds, ETPs are a cost-efficient investment option. Transparency. ETPs typically disclose their holdings regularly, allowing investors to monitor their investments closely. Tax efficiency. ETFs, in particular, often provide tax advantages due to their unique structure and in-kind redemption process. Lastly, flexibility. ETPs can be used for various purposes, including income generation, hedging, and speculative trading. I will be wrong if I do not inform you about the risks of exchange-traded products. The risks are majorly market risk, tracking error, liquidity risk, credit risk, and complexity. You have to be very mindful. Truthfully, exchange-traded products, ETPs, have revolutionized the way investors access global markets, offering a blend of liquidity, cost efficiency, and diversification. Whether used for long-term investing, income generation, or tactical trading, ETPs cater to a wide range of investment needs and preferences. However, understanding the specific risks and characteristics of each type of ETP is essential for making informed investment decisions. As financial markets continue to evolve, ETPs are likely to remain a cornerstone of modern investment strategies. Okay, nice one, guys. Thanks for watching. I wait your questions at the comments.